Our next section is going to be on common audit findings. And we have two presenters here again, Shari Scott and Valerie Hamilton. Both are audit managers in our office. Shari graduated from Western Kentucky University in December 1996 with a bachelor's in accounting. She's a certified public accountant and started her career with the Auditor of Public Accounts in 1997. In her 20-plus year career with the office, she has worked on many different types of audits, including local government audits and special examinations. She currently manages county audits for the office in 31 counties throughout Western Kentucky. Valerie has a degree in business administration with an accounting emphasis and obtained her certified fraud examiner certification. She's worked with the Auditor of Public Accounts for over 20 years as well. She's worked as a financial auditor and auditor in charge over state and local government audits. She's assisted in the performance of numerous special examinations, assisted in revising audit programs and trainings, and she's currently the central branch manager where she oversees the audits of local governments and the work of auditors in 32 counties. Shari and Valerie, I'm going to go ahead and turn this over to you. And Shari, there you go.
Okay. Good afternoon, everyone. As Jonathan said, my name is Valerie Hamilton. Shari and I are going to go over some common audit findings that we see. We did just want to make a note that the findings that we discuss are not intended to be all-inclusive, but just some common findings that we see in our audit reports. There may be other findings that you see in the audit reports, but it's just based on their particular circumstances. There we go. So now I'll discuss the objectives of our presentation. We're going to identify what a finding actually is, discuss some common audit findings, provide mechanisms on how to correct those audit findings, and answer any questions at the end. So you may be asking yourself, what is an actual audit finding? An audit finding is our way of communicating deficiencies in internal controls and/or noncompliance with applicable regulatory requirements. The findings are presented when they are of sufficient importance that they should be called to management's attention. A finding is a result of a deficiency or weakness in internal control over financial reporting and/or noncompliance with the provisions of laws, regulations, contracts, or grant agreements that affect the financial statement or other significant financial data. There are three types of findings. There are verbal, exit, and audit report findings. Verbal findings are more commonly referred to by our office as verbal recommendations. There are recommendations that we make that could provide improvement and/or help prevent noncompliances. As indicated, the auditors will verbally discuss these findings with you. The next one is exit findings. Those are communicated with management in a written format. These are findings that need to be brought to the attention of management, but do not rise to the level of being reportable. An audit report finding, those are the more significant or material issues. Report findings are as follows. We have material weaknesses, which is a deficiency or a combination of deficiencies in internal control over financial reporting, such that there is a reasonable possibility that a material misstatement of the entity's financial statement will not be prevented or detected and corrected on a timely basis. There are also significant deficiencies. Again, this is a deficiency or combination of deficiencies in internal control over financial reporting that is less severe than a material weakness, but important enough to merit attention to those charged with governance. And then the third one is called a material noncompliance. Again, this would be a noncompliance with applicable laws and regulations. There are several factors that go into determining the type of audit finding. One big one is whether an actual misstatement has occurred and the magnitude of the misstatement. For example, what is the dollar impact of the misstatement? Other factors include if there is a reasonable possibility that the controls you have in place will prevent, detect, or correct a misstatement. For example, Do you have procedures in place that are designed to find the misstatement I just talked about? If you have good checks and balances in place, that can help reduce the type of finding that would be reported. There are a few other factors listed here, as you can see, but I'd like to highlight a couple of them. One of them is cause and frequency. Was it a one-time error? Does it happen multiple times each month? Susceptibility to loss. How easy would it be to steal? Like cash, it's inherently risky because there's no paper trail, and once it's gone, it's gone. So for something like cash, you need very good controls in place to protect the asset. Findings will generally be related to a lack of internal controls and or non-compliances. Liz just gave a wonderful presentation on internal controls. And as she explained, they are defined as processes designed to provide reasonable assurance regarding the achievement of business objectives. So your internal controls have three main objectives: to promote effectiveness and efficiency of operations, to ensure reliability of financial reporting, and to maintain compliance with applicable laws and regulations. Compliance is related, again, to applicable legal and regulatory requirements. The Department for Local Government is your regulatory agency and has been given the authority to prescribe a system of accounting by KRS 68210. As a result, the guidelines that are established by DLG are required, and if they're not followed, is considered a non-compliance. Now, Shari is going to get us started with a very common internal control finding that we see very often.
All across their great Commonwealth, we have see a lot of internal control findings, but there's one that stands out more than any other. It's the segregation of duties. And this has been covered a couple of times already, but we want to go over what it shows up in your finding as, and then what you can do to prevent that. Many of our officials have very small offices and do not have enough staff to properly segregate the duties. And we get the question, well, what can I do if there's only one or two of us? Well, to answer this, first we need to define what the segregation of duties is. Each transaction of your financial transactions that happen have 4 different areas that happen. Liz has already covered this, but someone authorizes, someone executes, someone records, and someone reviews. These are called critical processes, and if one person does all of these processes or a majority of them, you no longer have the segregation of duties. In a perfect world, these duties would all be segregated. And just to give you an example of a real world example, what would happen if the keys, lock, and code for our nuclear weapons system was in the hands of one person? Emotions, coercion, blackmail, fraud, and human error, or just in disinformation could cause a grave and expensive one-sided action that cannot be corrected. And just to give you a visual on the segregation of duties, this is an example of a payroll. Excuse me. Some counties will have a human resource officer. That person is the one who's authorized to hire and fire. This would also be our elected officials in our fee offices and a jailer. But that person would authorize the hiring of someone. And then someone else should actually process the payment, calculate the payroll due, and then maybe even cut the checks. Then the treasurer and the counties are responsible for signing those checks. So the treasurer should also make sure that the payments hit the financials correctly. But if you don't have enough people to segregate these duties, what do you do? We know that due to budget constraints that many of our small offices cannot they don't have enough staff to segregate duties, and they struggle because they get this finding. But if they're incompatible duties, these need to be separated out. And when that can't be done, you need to implement what are called compensating controls. These are internal controls that reduce the risk of an existing or potential control weakness that results in an error or omission, and your compensating controls must be documented. Having adequate compensating controls instead of segregation of duties doesn't remove it from your exit, but it would take it out from just an exit reportable comment. It would take it from your report to just the exit, I'm sorry. And then an example of the compensating controls is the review of the process, such as the bank reconciliations. You've heard the bank reconciliations that are required. being discussed, but if one person performs a bank reconciliation, then someone should come along and check their numbers behind them. That person would be checking the source documentation and comparing the amounts to the appropriate record, and then also checking the daily checkout sheets to the bank deposit, tracing checks to invoices, performing the surprise cash count, and requiring dual signatures. And once again, we cannot stress anymore that any compensating control should be documented. Most findings that you'll see in an audit report have an internal control basis. So these are some other common ones that you might see in our audit reports. One, the lack of written policies and procedures, or you might have written policies and procedures and they're not being followed. Many counties, all counties are required to have an administrative code that acts as the basis, is essentially law for the county. And our fee officials, for the most part, are required to follow those admin codes. The second one is a lack of formally documented review and approval system. These need to be documented, and just because you say you looked at something, when the auditor comes in, they can't tell if you did or not. So like in the example of the bank reconciliation, we would say you could initial it, but you might want to say your initials and a date and what you did, that you traced to the bank statement, or you traced to the deposit ticket, something along that lines. Then missing or supporting documentation. You're going to hear a lot about this shortly, but your transactions must be properly supported. Anything that you pay money or receive should be documented. And then a lack of understanding your grant requirements. And in this day and age, when we have so much federal money hitting our counties, it's very important to understand what you just signed up for. Each grant that comes from the federal government will have oversight in it. It will tell you specifically what laws those grants fall under. And you need to get an understanding of those laws, because once you spend the money and if you didn't do it right, it's too late. And then if you have incorrect information submitted on your quarterly reports, if these amounts are material, they will rise to an audit report finding. Many people will ask, well, why do you have to look at all this stuff? We told you what we did. Well, auditing standards require auditors to examine audit evidence that the inquiry of staff is not enough, and we have to be able to back up that we tested what we say we tested. Now, on the flip side of that, how can you make those comments go away? You can have policies in place and hold your departments accountable. And it's very important, just like with the purchase order system, if you have one department who is not doing what they're told to do, you need to deal with it, because ultimately that's probably where you're going to have a problem. You need to train your staff. You really need a written policy and procedure manual so that new staff coming on can learn their job and know their job duties and what they're supposed to do and what they're not supposed to do. Also, being familiar with your applicable laws, regulations, and federal requirements. Several times during this presentation, and it will happen again, you're going to see various KRSs mentioned. I believe earlier in Jim and Leslie's presentation, there were 2 documents out there on the archives, and it's the duties of the county officials. Those are very good books to be reading over. And then, because ultimately you are the one that's responsible, you need to accurately monitor what's going on and know who is doing what. Also, when fiscal court approval is required, that needs to be documented. You need to be reviewing all of your processes, whether they're in-house or out, and you document your internal control policies. Several of our fee offices have come up with their own internal control policies that say who's doing what. Additionally, on page 64 of the DLG manual, there's guidance that talks about internal control and compliance. So while we're discussing the internal controls, the next few slides are going to deal with compliance areas. And I'm going to turn it back over to Valerie now.
So now we're going to go over some common finding issues that we have noticed with daily receipts. One of the more common findings related to receipts is not depositing receipts intact on a daily basis and agreeing them to the daily records. As Shari said, KRS 68210 requires that all county officials make deposits intact into a federally insured bank institution on a daily basis. So this means that however you get the funds is how it should be deposited. You should not be cashing personal checks out of your daily receipts. So how would you correct this? Again, you would ensure that your deposits are made intact. Intact means all monies received should be deposited as they were received. Payments made by check, the check should be deposited. Payments made by cash, the cash should be deposited. Again, do not cash personal checks. The makeup of the deposit should mirror the actual funds received for the daily business. So for example, if you receive $500 in cash and $1,000 in checks, your deposit should show exactly that. If you cash a personal check, your amount will not agree to your support. Another common issue in the receipts area is when pre-numbered receipt forms are not batched daily and a daily checkout sheet is not prepared, as well as when all documentation is not agreed between the daily records. This ties in closely with the previous slide discussing making daily deposits. So to correct this, just be sure to batch your pre-numbered receipts, including any voided receipts to account for the sequence. You should have a daily checkout sheet that is completed that outlines the various receipts and the amounts taken in for the day, broken down by cash, checks, credit card. The daily total from the daily checkout sheet should be posted and agreed to the receipts ledger. And finally, the deposit should agree to the batched receipts, the daily checkout, and the receipts ledger. Now we're going to go over some common findings related to payroll. When thinking about potential payroll findings, we will go back and hit some points from our previous discussion on internal controls to explain how to prevent or correct any issues. Think about what your major threats to payroll are and how you can minimize those threats by implementing effective internal controls. You will want to ensure that you have controls in place that will address management's needs, employee needs, and compliance with laws and regulations. For the payroll process, you think about the payroll input. It's going to be like human resources providing information on the hirings, terminations, etc. Employees provide information for any voluntary deductions. Employees provide timesheets to document their hours worked. Government regulations on tax rates. Various other organizations such as insurance companies provide information for calculating and remitting those withholdings. Your output is going to be your paychecks, payroll registers, W-2s, your direct deposit transactions, checks or ACHs to other organizations for withholding, such as insurance, payroll taxes, retirement matches, and various payroll reports. So as a result, there are normally common findings where policies and procedures have been put in place to verify and support the information that is input with the resultant output, and we will go over some of those now. One of the most common payroll findings is related to timesheet issues, such as timesheets not being prepared or maintained, missing employee signatures or approvals. The hours reported per the timesheet do not match the amounts paid to the employee. Without maintaining properly reviewed and approved timesheets, there's a lack of support for your payroll charges. In addition to the control aspect of this, there is a regulatory requirement that a record be kept by the employer. KRS 337-320 states that every employer shall keep a record of the amount paid each pay period to each employee, the hours worked each day and each week by each employee, and such other information as the commissioner requires. How you keep your records is totally up to you, but those records should include time records that are accurate and reflect actual hours worked, the time records that are signed by the employee and reviewed and approved. The hours will be supported by properly signed time records. The signature of the supervisor reviewing and approving the timesheet will provide documentation that the employee is charging the correct hours. And then you will ensure gross payroll is calculated based on the correct rate of pay times the number of hours worked per the timesheet. Now I'll go over a few other common findings and the solutions that we have for those. lack of payroll salary authorizations. Are you going to ensure that employee action forms are maintained, such as hire forms, deduction changes, salary adjustments, termination forms? All the forms should be signed by the employee, the HR employee, and management. Another one is overspending salaries established by the fiscal court. KRS 64533 states in part that the fiscal court shall fix annually the reasonable maximum amount, including fringe benefits, which the officer may expend for deputies and assistants, and allow the officer to determine the number to be hired and the individual compensation of each deputy and assistant. So basically, your salary limit should be submitted to fiscal court for approval, and your payroll expenditures should be monitored during the year to make sure that they are within those limits. There's a few more violation of employment laws. The solution would be to document all your actions related to recruiting, hiring, and dismissal, provide continued training to keep employees current with employment laws. Another inaccurate processing of payroll. Again, reconcile your totals before and after processing your payroll journals. They should be reviewed and reconciled to control totals approved by management or their designee. And then have like just about 3 more, not properly or timely reconciling the payroll account. Your payroll account should be reconciled monthly, just making sure that the amount that you're transferring over to the payroll account is supported by your payroll totals or payroll registers, etc. If you have any balance in your payroll account, that should be identified. Another one is giving bonuses. This one is simple. Just don't do it. They are prohibited. So just do not give out bonuses. And then office practice not in agreement with written policies and procedures. Again, just make sure that your code is written to what you're actually doing and that you're following along with what's in your admin code. Your actual everyday practice should be in compliance with your written policies. So some overall considerations for payroll is to think about, are all your transactions properly authorized? Are our transactions valid and properly supported? Have you maintained proper supporting documentation for the transaction? Are all valid, properly authorized transactions recorded and recorded accurately? Have you followed your written policies and procedures for all your transactions? And are you in compliance with your laws and regulations? The payroll cycle will often be one of your largest overall expenditures. So you just want to be very sure that you've maintained appropriate documentation to support the amount that you have reported on your financial statement.
Okay, now we're going to discuss disbursements. Four of the most common areas are no support or you have insufficient support for your disbursement. There are late fees and penalties, unallowable items, and then your procurement policies are not being followed or you're not bidding when required. If you have no support or insufficient support, you could have disallowed expenditures. This really affects our fee officials because they can be held personally liable for those. If you have disallowed expenditures on the fiscal court, they're not technically disallowed. You would have an audit finding, but if they relate to a federal grant, you could be required to repay those funds. If the invoices are missing, then the same would apply. In a fee official's office, they may be disallowed, and then on a fiscal court, it could very easily end up in an audit finding. Late fees and penalties are not allowed. They don't meet the requirements for our fee offices of Funk versus Milliken. And then it's just, there's no real reason to be paying late fees or penalties. They're not allowable. Also, you cannot buy alcohol. That's one of the reasons when you turn in a receipt for reimbursement, that's for meals or something, you've been to training, you want to make sure that you have not included the alcohol on there. And then if your procurement policies are not being followed and you're not bidding, that will also trigger a write-up. When many of our counties would like to use state contract pricing, and there's nothing wrong with that. Only thing is you have to make sure that the vendor you're using is actually on the state contract. They actually have to have secured that through a bidding process that's handled by the state. You can't go to your local vendor and say, hey, this so-and-so vehicle is $40,000 through the state. Can you price match that? Because even if they can, that's not an allowable transaction. And most of your procurement codes would not state that anyways. There are exceptions to this, though, if you are following the model procurement, and we'll discuss that in a bit. The payment of the late fees falls under the KRS, where it says all expenditures must be made within 30 days. You have to pay your bills within 30 working days, or you're subject to fees and penalties. Some things to think about: are all your transactions valid? Were they properly supported? And do you have the support for the transaction? We also want to make sure that those transactions are all handled properly and recorded accurately, and then document. If you have to do something that's outside your written policies, you will probably need fiscal court approval to do so, and you should document that in your minutes. Another thing to ask yourself, are you in compliance with your applicable laws and regulations? How do you avoid a finding related to your disbursements? Is first off, know what's allowable and what is not. Second off, know which procurement policy you're following. Many of our counties are following KRS 424-260 that discusses the bids for materials, supplies, equipments, or services. And it states that the statute, unless the statute specifically fixes a larger sum as the minimum requirement, no county, city, district, etc., sheriff or county clerk can make a contract or lease for materials, supplies, except as perishable items, equipment, or contractual services other than professional that involves an expenditure of $30,000 or more. One thing to note is if your admin code has not been updated, you'll have to, follow whichever one is the smallest. It's also important for our fee officials to note that a sheriff or county clerk can be held to a lower minimum if the fiscal court requires it. And if your county has adopted the model procurement code, you will need to follow all the procedures that are listed in KRS Chapter 45A. So most importantly, know which one your county is following. Some things that are very specific to our fee officials. Some of the common problems, and you'll see audit findings related to these, are moving funds between years. For our under 70 counties, each calendar year stands alone, and our over 70 counties, each term stands alone. For our under 70 counties, excess fee settlement should agree to your ending cash balance and be remitted to fiscal court. You cannot pay the next year's expenses out of any prior year remaining funds that you have. Our over 70 counties, all the funds collected within a year should be remitted to the state for deposit in the 75% and 25% accounts. Any deficit is required to be made up before the end of the term. Jonathan, I'm sorry, I'm going to have to get a drink because I'm going to lose my voice.
No, I understand. Going for a full hour at any point in any of these takes a lot out of the voice, so we appreciate you doing that. I want to remind everybody that we've got a little bit longer to go, and we're going to take a break at 3 o'clock. And if you're having any questions, or you have any questions, if you're having any issues, or you have any questions for the presenters, just make sure you're using that APA website or that APA email address, and we'll be sure to address those if there's time.
Okay, once again, we want to talk about Funk versus Milliken. For our fee officials, unallowable expenses can be disallowed. That means you would be personally responsible for repaying those funds. In Funk versus Milliken, Kentucky's highest court reaffirmed the rule that county fee officials' expenditures of public funds are only allowable if they're necessary, adequately documented, reasonable in amount, beneficial to the public, and not personal in nature. If an expense does not meet these requirements, then it can lead to disallowed expenses. And the official, like I said, is personally responsible for this. If those amounts are significant, you will also see it in your audit report. Again, examples of this are purchasing items for personal use, or providing maybe a room for your spouse to go on travel and paying for that as well. Alcohol on a meal expense, travel payments for yourself or people in your office that exceed what your county administrative code or your state, if you follow the state regs, what that allows. And then if you're missing support for detailed, if you're missing support, you can't just use summary totals. You need to have detailed bills that for such items as cell phones and gas cards. It can't just be the summary only portion. And you need to keep the entire statement, because auditors will look at the entire statement just to see who is using those phones and vehicles. Now, how to avoid the finding, and you guessed it, maintaining support, acceptable supporting documentation or original bills, invoices, or receipts. They minimized. If you're purchasing things offline, you need to be downloading the documentation that supports those. You also need your original contract or agreement. For your credit card, a credit card statement, again, is not enough. You need all the invoices that back up that bill. And then you also need the supporting documentation for the purchases, which is the original bills, invoices, or receipts. Excuse me. If there are amendments to your contracts or agreements, you need to keep those as well, and they should be maintained in the office, and then know what you're signing up for and what's allowed. Now we want to talk about common findings that are related to reporting. And a lot of the things that we're going to cover through here have been covered on other slides, but I think it just goes to show you the importance of these and where you're going to get a finding if you're not following these different rules. One of the most common things we see is your four-quarter financial statement being materially misstated. And by that could be your cash balances. The cash balances could be incorrect. The reconciliation that appears on the first page could be incorrect, or you've not included all accounts. Your receipts and disbursements may be materially misstated due to material errors. They're not cumulative, and they're not supported by ledgers. Also, you need to cross-foot and foot these ledgers and cross-foot the ledgers and the reports to make sure that they title up, because we will come back and re-add those, and if they don't, we could have a finding because of it. Another reason or issue that we find are significant items being omitted. If you omit the debt, the liability section, if you omit significant receipts or disbursements. And now you also should be including a CFA and a lease worksheet. Both of these are available on DLG's website. And just to hit back over the dates that were discussed earlier, the four-quarter financial statement is due by January 15th of the following year. That's what we audit. If for our fee officials on the fiscal court, I believe it says on the face of the four-quarter, it doesn't have to be turned until July 20th, but the KRS says the 15th of the month following the end of the fiscal period. Significant receipts that you receive that are due you and you received them before those dates, such as January 15th, should be included on your report. An example of this could be commissions. Say in a sheriff's office, you included your commissions that you paid yourself in the following year. Well, depending on what you've been doing, it may need to be recorded in your current year, especially if you're going to need those funds to not have a deficit in your account. You can also, if you have trouble, we've heard this from many officials saying that their bank statements, they don't get them in time. Well, you can always go online or go to your bank and ask for a cutoff statement. That way, you will have all your activity that has happened and give you a few days to be able to make your four-quarter settlement. Also, the front page of the four-quarter should include all accounts. If for all your fiscal courts, that are the funds that are budgeted, and even if you have accounts that are not budgeted, they're supposed to be on there. On your fee officials, you want to include all accounts, your fee accounts, and your grant accounts. If you are holding money for someone else, we do have a few officials that have escrow accounts that needs to be reported. But a sheriff's tax accounts do not have to be reported on the four-quarter because that's not under the purview of the Department of Local Government. And once again, want to remind you to include your CFA and your leases worksheet. Now, how to correct this, and you have seen this information in another slide, following the county's, the DLG handbook. They're very specific on what goes on the first page, the second page, or the second section, the third section, fourth, and so on. Make sure on the summary and reconciliation page that those amounts add up. Same for the receipts section. Make sure that on your contingent liabilities, you've included all debt that is outstanding of the fiscal court, or if it's your fee office. Then you do an appropriation condition report, and that shows your budget to actual. And then for fiscal courts, they have a fixed asset section, but that's only for fourth quarter. And then, of course, your CFA and now the leases. And just to give you some examples of what we're talking about when the fourth quarter, the front page is not balanced, you'll see this is an example of a fiscal court fourth quarter. And if you come across to the cash balance, that should foot across. And then that dollar amount, the $6,895,250, is the same as the bank reconciliation portion that it's at the bottom. If these two do not agree, you need to find out why before the auditors get there, because it's very hard for us to go backwards. Also, the total receipts is going to be on the next page, and those numbers should tie your claims and your receipts to date. And this is a summary page again, and you'll see where the bank balance and the fee balance should agree, whether it's for a fiscal court or if it's for our fee officials. The one on the left is a fee official fourth quarter, and the one on the right is one is for the sheriff and one is for the county clerk. But again, the receipts and disbursements should agree to the pages that follow. Things to watch for. Be sure that you're completing the fourth quarter. If you have significant accounts receivable, such as commissions, you want to make sure to include those. Also, on excuse me, on the disbursement side, if you have significant unpaid obligations for your fee office, you would want to make sure and list them there. A really good example of that is I'll use our county clerks. They collect usage and property taxes and license and fees all the way through the end of the year. Well, as of 12/31, they don't have to write out their reports and pay those taxes over until the 10th of the next month. But they would know that that money is due to somebody else, so they should list those as unpaid obligations. Like I said, again, you can request a cutoff bank statement if you're unsure about things that have been deposited. And this is regardless if you're a clerk or a sheriff or a fiscal court. And then make sure you list all your receipts and disbursements in the correct categories. If we have to make significant adjustments, if it's just for presentation purposes, that won't cause a finding. But if you're hiding certain disbursements and calling it something else, then that could lead to an audit finding. Just make sure that the amounts that you're recording in your totals for receipts and disbursements tie back to your ledgers, because that is your support for the amount that you're giving on the quarterly. One thing that we found when we were looking out on DLG's website, they provide a quarterly report check sheet. There's one for the sheriff and one for the county clerk, but they're very similar. And this could also be used by our treasurers for their fourth quarter financial as well. One other reporting issue that we've seen is failing to prepare and submit a jail commissary report. These have been covered earlier as far as the requirements in the DLG handbook. Those start, those start on page 64. There's no specific date that report is due, but it should be submitted shortly after the end of the fiscal year so that it's there and ready when the auditors come. Because if you don't have it ready, we know that you've not prepared it, therefore that could cause an audit finding. It's a good practice when you do this. It's due to be turned into the county treasurer. That's what's required by the law. Sorry. But it's a very good practice to present that to your fiscal court. And that way it becomes a part of the record and no one can dispute as to when that report was turned in. Also, the jail commissary report is a financial report on the canteen and commissary activities of the jail. Many of our jailers already have to turn in a report that talks about the number of inmates they have and different things that relate to jail activities, but this is an additional report. This report should also include the information on inmates, not just the commissary. It is very important that you follow the prescribed format that DLG has provided. And when the auditors come, they're not going to write you up if you don't have that exact format, but you do need to have the same information that's included. Also, inmate activity should be, maintained separately. the funds that you hold for inmates are considered fiduciary funds. That means you're just holding them for someone else. So the ins and outs of those activities should not be included on your commissary. Once again, the guidance for reporting on the commissary and canteen account is found in the DLG manual starting on page 65. There's an example report, example ledgers, and also a reconciliation that's given. Now I'm going to turn it back over to Valerie.
Okay, we're going to discuss a couple other additional findings that we see. One of them is in regards to the failure to keep adequate records for the sheriff's donation account. The sheriff can accept donations for a public purpose if the office is in accordance with KRS 61310. However, this is not an option for the county clerks. The sheriff may accept a donation of money or goods to be used for the public purpose of his or her office if the sheriff establishes a register for recording all donation that includes, at a minimum, the name and address of the donor, a general description of the donation, the date of acceptance of the donation, the monetary amount of the donation or its estimated worth, and any purpose for which the donation is given. This register will constitute a public record and be subject to the provisions of KRS 61870 to 61884, and be made available to the public for inspection in the sheriff's office during their regular business hours. So again, this register is a requirement. The funds should be maintained in a separate donation account. Any funds that have been donated should be used for their specified purpose. And any donation to the sheriff shall only be used to further the public purpose of the office and not be used for the private benefit of the sheriff, of his or her deputies, or any other employee of the office. All donations made in accordance with this subsection shall be expended and audited in the same manner as any of the other funds in the sheriff's office. So how to correct this is just, again, to maintain the ledgers with all the required information per KRS 61310, maintain a separate bank account for the donation, use the funds in accordance with their specified purpose, and keep adequate documentation for those funds that were spent.
Another issue that we sometimes see that applies to our sheriff's office is failing to file the statement of seized property. KRS 68A 440 is a statement, it talks about statement filed listing your property seized and then investigation of the utilization of the proceeds. Each law enforcement agency that seizes money or property pursuant to KRS 218A shall, at the close of each fiscal year, file a statement with the Auditor of Public Accounts and the Secretary of Justice and Public Safety that contains a detailed listing of all money and property seized in that fiscal year and the disposition thereof. The listing shall identify all property so seized. That listing should include all items seized, whatever happens as far as your disposal of the property. It needs to be documented on this statement. The list should also details whether they're being held until judgment has been rendered or if it's been awarded or disposed of. The KRS goes on to say any agency that failing to report as required by this section is liable to the state and the full value of the property and money so seized. The Attorney General shall institute civil actions for the recovery of the money or the property obtained and retained in violation of KRS 218-405 and 218A 460. The Auditor of Public Accounts, the Secretary of Justice and Public Safety, or the Attorney General may at any time initiate an inquiry to determine that the property is being forfeited as required by KRS 218A and 405 and then 218A 460. It's also very important to note that funds that have been court ordered are the only things that you can put in your drug fund. As far as the state drug fund, those would come from your local judges. That may be a commonwealth, it could be a district or circuit issue. But those funds should be maintained separate from a federal seizure award. Federal Seizure Ward has a set of its own requirements, and these are included in the Equitable Sharing Guide that is put out by the Department of Justice in cooperation with the Department of Treasury. If you get funds in your drug account, you spend those for what are normal operating expenses or law enforcement expenses of the office. But one thing to note is you cannot use those to supplement. No, you cannot be required to use those to supplant your budget, and these are only to supplement. And there are very specific uses for these. And just to give an example of something that would be not allowable is if, say, in your fee account, you don't have enough money to purchase a new vehicle, and this is something that you really need, but you have enough money in your drug account. That vehicle can be purchased out of the drug account as long as it meets the requirements. But once your fee office budget gets the money in for the year, you cannot repay the drug account with those funds. The only thing that can go into those funds are the monies that are awarded to you either through the state or local courts or federal. And the way to correct this is to file your seizure statement in accordance with KRS 218A-440 with the auditor's office. We do keep those on file, and the Kentucky Department of Justice. You will need to maintain separate bank accounts for the seized funds unless they're needed for evidence. And then also any funds that you have seized can be put into a separate account unless the prosecuting attorney says you need to keep those physical dollars as evidence. Otherwise, they can be deposited into a separate account and maintained there. You would need to keep a list of your deposits, what case it was related to, and then cross-reference any police reports that might support that. Also, you need to keep adequate documentation for disposition of all items seized. So if you decide to surplus these items, you will need to follow your county's surplus properties regs in order to surplus these and then take the money for them. But ultimately, if you don't want to have an audit report comment, it's up to you. You need to implement the internal controls that have been discussed, and then also follow the different KRSs, KARs, and federal requirements to keep you in compliance. And I believe, are going to have time for a few questions, Jonathan.
All right. I got several that came in throughout the entire presentation. So whoever wants to jump in and answer them between Shari and Valerie, feel free at any time. I'm going to start with this one here. Do jailers have to follow the same disbursement rules that the county follows for commissary or canteen purchases?
I'll take that one, and the answer is yes. They have to follow all requirements that are listed in the admin code. But additionally, there are additional requirements. They're contained in KRS 441-135, which is the KRS that deals with the canteens for inmates or prisoners. And it states that the jailer may keep a canteen or commissary account for the use of the prisoners, but the expenditures have to be meet some certain guidelines. All the profits from the canteen has to be for the benefit of the prisoner and to enhance their well-being. There are several different categories that they can come out of, but some examples would be like medical or enhancing safety. And then also additional expenditures would be recreational or vocational for the inmates. And these, just like any other expense, should be properly supported, and they should not have any personal nature for the jailer or their employees.
Okay. We had one that came in that I think is going to be maybe too specific for this training, but I'm going to generalize it a little bit to make it a little easier and applicable to everybody. If people want to donate money to a detention center, and then they had a specific account, but if people were wanting to just donate money to the detention centers for use, is that allowed, or how do they go about that?
I'm fairly certain you cannot just donate to the detention center. It would be a donation to the fiscal court. But you need to understand that once it goes to the fiscal court, it's at their discretion on what it's spent, unless there's some type of legal strings attached to it. That's just a general statement. I mean, you would have to look at specifics, but as a general statement, the only one who can accept donations through the KRSs are the fiscal court and your sheriff for office use.
Right. And we do want to make sure that any advice we're giving here is generalities. If things change, there are specifications to any question. We're just trying to answer as many of them that come in as possible. Another one asked, how am I supposed to respond to exit and report findings?
You should take your time when you respond to exit findings and report findings, because everything that's in the exit conference could ultimately end up in a report. And you need to be very specific, address the issue that the write-up was about, whatever the non-compliance or the internal control issue was. You should come up with a plan and how you're going to fix that problem, and then who's going to be responsible for fixing that problem. Also, it's important to note that we cannot edit or add to any responses that are given to us. So when you send those in, please make sure that you've checked your punctuation and that your spelling is correct on those. If we can reach you, we will try to get those fixed, but ultimately it becomes your responsibility to make sure that those address the issue.
Sorry, my dog decided to go crazy there right as I was about to ask the next question. I'm going to ask this and mute it, try to calm the dog down, but this is a question about the liabilities outstanding for each quarter form. If the equipment is leased only and you have no intention to purchase the equipment, should the items be listed? And then they had some examples of computer equipment and software. And before you answer, I would recommend going forward, there's been a lot of changes on leases and lease requirements. So definitely look into those. There's a lot of trainings that go on right now that can probably be very specific, but I thought maybe you could speak to it just a little bit. I don't want you to go into too much detail on leases though.
No, and I'm not gonna be able to address everything in the leases. What I will say for our counties, and whether it be a fee office or the fiscal courts, many of you are adopting resolutions, setting reporting thresholds, and that's fine, but you will still need to keep a full list of all the leases that you have so that they can be evaluated. It's very similar to like your capital threshold, your capitalization threshold for your capital assets. You can have one amount that you're reporting because you've set a threshold, but you may be required, you should be keeping a full inventory list, whereas not everything on that inventory list is going to get reported as a capital asset. The same goes for these leases. You should keep a full list, whether it be computers, copiers, whatever it is. Don't forget your AOC buildings, because a lot of those are being paid directly to the bank for our counties, but those are leases where you're actually the lessor, not the lessee. So those are just some general guidelines. And if you do have specific questions, we'd really like to get those in writing so that maybe we could address any specific incident or, the specific details that you've got a question about.
All right, how about this? What if I find documentation after the audit exit is complete? Can this get rid of a finding?
It's going to depend. That may be a yes and it may be a no. Sometimes we will receive documentation that explains what happens and it reduces the risk of that item being a material error or omission or fraud. But then sometimes we'll get information and it really doesn't change the effect of the finding. And I'll give an example of that. We might come in and say we're looking at payroll and we say, okay, well, we need to see all these timesheets. And for some reason, 4 or 5 timesheets are missing. And maybe that's a different office, just say like a county attorney's office, or if you have some other location and they're not turning their timesheets in like they should be. Well, you go ahead and do the payroll processing for them. Well, if you show me a timesheet later, we already know that it was never presented to you or to the office for payment first. So you didn't have supporting documentation before you made the expense. So that would not necessarily get rid of a finding. But we have had some where they said, oh, I didn't understand what you were asking for. And they are able to provide the documentation and it's clearly dated. You can tell they had it all along and that type of thing. So unfortunately, again, the answer is it just depends.
All right, I think we're going to do one more. And because we're talking to new officials and, some of this training is also to alleviate worries, to let you know that this is a a common thing. You know, we go through these audits regularly. You'll be going through them regularly. I was asked, what's the most common what's the most common finding type? And they were really specifically asking, is it in the audit report? Is it a verbal finding? Is it something that goes in the exit conference? And I know we don't have percentages and we're not saying, you know, we see this, but just to alleviate some fears, do you think we see more exit conference, more verbal, or more reports?
I would say it's a combination of all of them, because we have some counties that have done an excellent job. They've got their records in order, and they might not have a written finding in their audit report or even in an exit. I will say that the number of those are not huge, but there's a good portion of them, especially like it was talked about earlier in our fee offices. That's why we were able to do the agreed upon procedures. But we do see, generally, I'd say about the same amount of verbals as you do written exit comments, and then maybe a third of that rise to the report.
Yeah.
Not to give it exact amount, but that's kind of the way it seems to fall, or at least in my district, that's really all I can speak to.
Okay.